like Morgia with Morgia Wealth Management. And over the last few months, we've been releasing some videos to help clients and investors in general understand what's happening with the markets, what's going on with the economy, how the virus has been affecting investors. And probably a week and a half ago, we sent out an email to clients and asked them what questions they wanted answered. We think we know what everybody's thinking about, but sometimes better just to ask. So we've got a pretty good response over the last few weeks, and many of those questions kind of fell into one big category, which I'm going to deal with today. This video will be a little bit longer than some of the others. But this question was basically, should we bail out or should we buy? And some clients asked that just like that with both sides of it. Others were more worried. Others were more maybe aggressively thinking about the buy side. So I was going to take that question today and kind of go through how we think about it. What should investors do? Is it worth considering getting out? Is it worth considering adding? What should you do? So before that, I'm just going to give you a quick overview of where we are, how we got here, and what's really happening. So I'm going to try to pull this off in 20 minutes, which means it'll probably take about 30 minutes, but let's see how we do. I'm going to share my screen if I can here. Let's try this. And hopefully that worked. You should see my cursor. So before we get into it, let me just explain how to read these charts. Each one of these sticks here, if you can see my cursor moving around, each one of those sticks is a month. So the high for the month, the low for the month, the close for the month, and this is the stock market in general. So you see over month after month, the market's going up, 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 and then all of a sudden it takes a huge 35% hit. Then it rebounds a bit, and this is the point where everybody's wondering, hey, is this rebound going to continue, or are we going into, maybe this is just the start of something worse? And luckily, I do know the future in this case, because this is not now. This is when I started in the business. It was the crash of 1987. And although many people at the time thought that we're going into another depression, or at least a really bad recession after this huge run-up that we had. I'm going to do some annotation here. If you see the, this is year after year of a very big run-up. I guess I could have picked a better color. This whole run-up here was huge. So this crash, people thought, was just the beginning. And but what really happened was we did not get a furtherance of the crash. We had the 35% hit. We came back, and then the market recovered. It took about a year, and it surprised a lot of people. Then we kind of came into 1990. The savings and loan crisis was happening. A lot of the banks were going under. Recession started, which is what this little gray bar means. And I remember reading a book that was called The Great Depression of 1990, predicting that we were going to go into another Great Depression, which is a common theme whenever we have a market crash of greater than 15 to 20%. The depression story will pop out. It's really done that for every crash of my 33-year career. And it was no different here, especially since a lot of the banks really did crash terribly, maybe 90% down. But that turned around, and then surprising to a lot of people, we had a huge rally, and the market went up, 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 and then up again, and then up some more. One other note here, the only other line on these graphs that I want you to look at are these dots. Every single quarter, different stocks report their earnings. And this is just the earnings of the stock market in general. It's all the profits of all the companies in the index. And our rule at Morgia Wealth Management is that the price of the stock market or any stock can't go up too much faster than the speed of those profits growing. And turn on my annotation here. So as the spread gets greater, this is what we call getting more expensive. Down here, it's reasonable. If the stock price was under that green line, that would just mean that the PE ratio was under 15. 15 is the norm, which on this line just means the price will touch the green line. So this is getting very expensive here, and people were starting to get quite nervous and get rid of these lines. And people thought, here comes the crash. But it turned around and went to a new high. But eventually, this kind of crazy price level did lead to problems. And let me just alter my scale here so you can see it. Eventually, we started to come down. We had a 35% hit, kind of like we just did. People were thinking, oh, maybe we'll snap back. Others said, no, we're going to go down further. And as we all know, it was a pretty nasty hit, 50% down. The tech stocks got really smashed. They were down maybe 80%. The market in general was down 50%. Everybody was in panic mode. And it turned out to be one of the best times you could buy. Because over the next few years, the market rebounded back up to the old high, which, if you're down 50% and you go back to the old high, that means from the low to the high, you make 100% on your money over a few years. Then came the financial crisis. And shifting the scale here, this first drop was a few years. This one was a lot faster. It was about 1 year in length, and the markets went down 50%. Right about that time, they were speaking of the Depression again. Here comes another bad market, but that did not happen. What happened was it turned around, and this is the last, bull market that we've just gone through for the last decade or so. But you can see, though, it took 13 years really to get back to the old highs, which was pretty dramatic and pretty shocking to a lot of people. And there was a lot of money to be made if you were nimble, but for the most part, if you just sat there, you didn't make a dime for 13 years. So fast forward a little bit, we had a couple of rough patches here, 20% down, 20% down. In 2018, we had a pretty nasty Christmas where the market was down 20%. Normally, that does not just turn around and go back up that quickly, but it did, and we hit a new high, and then finally is today, a 35% very quick drop with a fairly decent rebound so far. And so the questions come out, what should we do? Is this time to say thank you and goodbye because we've got somewhat of a reprieve here, or are we just going back up to new highs again? When the market does this, everybody always talks about depression. And so that doesn't help us. You can't tell us if we're going to actually have that kind of a market or not, because they always say that. It's possible. So getting into some of the questions, specifically, one of our clients, Kate, asks, she says, I have neighbors on one side that think that the virus never existed. I have neighbors on the other that think we're all going to die from this, all going to die at the hands of the virus. And she's worried that if there is some kind of, maybe some kind of a resurfacing of the virus, that people will get even more emotional that what we've done did not work, and the volatility could get even worse. So that's one side of it. Another client of ours, Karen, asks, as we face the drop in the market, I'm wondering if this is the time to actually do some buying since prices are down. And so you can see both sides. And throughout my entire career, 33 years, not only have clients wondered both sides of the story, but we see experts on both sides. Some say, yes, we're going to head into a depression. Some say, no, the technology stocks are leading a new revolution. Things are going to be good. We'll get through this eventually. It'll go up. And I've learned over time that you're not going to predict that. Really, any investment method that relies too heavily on predicting the future is, I think, doomed to failure. So our strategy has to have something more to it than that. It has to have an all-weather kind of attitude. So if the storm hits, we can deal with it. If times are good, we can deal with that too. And we don't need to actually predict what's going to happen because it won't work. Even the virus itself, nobody saw it coming. That's how these surprises work. I guess a few people thought it was possible, of course, but nobody knows when. So that's kind of the main topic we'll hit and the main question I'll answer. But before that, I just have a couple other questions from clients that I thought we could get through quicker. One is, I'll read it to you. In talking with other investors, many of us find it strange that the market has rebounded as well in these dire times. What does your firm feel are the reasons for the rebound today? And do you think it'll be short-lived? So let me see if I can pull up. Here we go. So this is day by day for the last year or so. And you can see the market getting really slammed here, 33% down. This is the S&P 500 from 3,400, if you can't see that, down to 2,200. So 35% hit. And the question is, why is this rebound happening when all the news is bad? And the quick answer is the market's always trying to think 6 months ahead. When the market got smashed here a few months ago, earnings were still good and the economy wasn't as bad as it is now or as it's going into. So the market tries to guess ahead. Once we saw that there was enough beds procured for New York City and the respirators were delivered and the country was kind of coming together to fix the problem, people said, oh, you know what, I know things are terrible right now, but 6-7 months out, we'll be through this. And that's why the market was up. And now the question is, yeah, we'll be through it, but how easy is it going to be to restart the economy? And the market's trying to guess that every day. Today, as we speak, they're guessing that it'll be okay. I think the market's up 800 points today. In fact, we're at the highest point since the crash happened. We'll see if it lasts. Another client asks, is there market data from 1918 pandemic that can shed light on investing in the near future? Meaning, can we draw any conclusions from historical cases of viruses and pandemics? So if you look at SARS or anything recent, those weren't as bad. They had hardly any effect on the market. But let's go back to way back to 1918. This is a chart of the Dow Jones way back. And I'll walk you through it if you can see my cursor. This here, actually, I'll do some annotation here. This level here was right before World War I broke out. They announced it. They closed the market for 4 months, which would be really nice if they would do that for us now. When they opened the market, it was down 50% from the high. This level is about 100. This level is about 50. You can't see the scaling. It's over on the far right side. So that was a pretty bad hit when they opened it up, but it skyrocketed straight up and 100% in a year. And then what happened is, let me see if I can do this. I'm going to have to turn the annotation off. Get my mouse back. So what happened is we came into the war, the US did here, and the market then went down quite a bit. The pandemic of 1918 kind of got started here, Spanish flu, which if you read your history books, most experts also think kind of originated out of Asia. And it peaked out right about here. And this is 1918, I believe. Yeah. So 1918, the peak was here and here. So the market went down about 15% and then skyrocketed up. And then later, a year or so later, had a pretty bad recession. And then skyrocketed back up and then took off. So it doesn't really help us much. The market was a lot cheaper back here, which is one of the reasons why it made that huge move later in the 20s. So that doesn't help us. The last pandemic was the Hong Kong flu in 1968, and I guess that doesn't help us much either. There was 100,000 US deaths, which is the equivalent of in today's population. That would be like 150,000. So it was pretty bad. But their idea of social distancing was to have Woodstock right in the middle of the pandemic, which maybe that was the cure. I don't know. I doubt it. They also had the World Series the year before and after. So they had just a different philosophy back then. So it didn't really affect the economy as much, but there was other things going on back then. And this is back in the 60s here, 1968. There was just a bunch of rolling corrections and crashes. The 1974 crash was a 50% hit. There's only been 3 of these in my lifetime. And so it's hard to tell. Other things were going on. The Vietnam War was sucking up a lot of money. And when it did that, you just had not much going on with the stock market. In fact, it was 16 years of just back and forth. So that doesn't help. And let's see here. So that doesn't really give us too much insight. And we're not going to be able to find out one way or the other what's going to happen by guessing what the future is going to be. And part of the problem this time is really that this may have just been a symptom, and the real problem is the world debt situation. If you have to shut down your economy, if you haven't borrowed a lot of money and you've saved money in the bank and you're a corporation like Warren Buffett's company, Berkshire Hathaway, you have a lot of cash reserves. There's not too much worry of there's really no worry of bankruptcy. And if all companies were like that and all citizens were like that and all governments were like that, we would get through this I won't say easily, but there wouldn't be the worry that we have. The worry is out there because we have too much debt. And if this recession is bad enough, it could spark a debt crisis. And so that's kind of the real worry that we have. And all that money printing could cause problems. Back in the 60s, here's a chart here, if you can see it, it sparked inflation. There was a lot of spending going on. This is government spending on the bottom chart to fund the war, basically, in Vietnam. Government expenditures jumped up tremendously from 4% growth rate to 15% a year. And then the top chart here, you can see this is inflation, went from relatively nothing to all of a sudden very bad inflation. And it made interest rates go up, which really, if you look on this next page, this just shows the red line is what the stock market did with dividends. This is the stock market without dividends, and this is the 10-year bond market. And the bottom chart is more explanatory. Inflation adjusted over, 1964 through 1970, you made not a lot of money in stock. You lost money relative to inflation, except for the fact that your dividends helped. So in this kind of market, we're looking more for some solid companies, good balance sheets, dividend paying perhaps. If you were in the 10-year bonds, $100 turned into $85. So you lost money for 6 years. At the end of the 6 years, you were down quite a bit. So that's the danger. And then add to this kind of thing, which was just a lot of spending, add to that printing. We're printing so much money that some think that's really going to be a major problem. So I'm going to wind it up with, what do we do about this? And I came up with a series of questions that any investor has to ask themselves. And the first one is, why do we own stock over the long run? And do we want to? And basically, the question is, why are we in the stock market to begin with? It's always a roller coaster. A lot of times it's not very fun. And I'm jumping back into the early chart of the Dow Jones, way back to the 20s. So huge run up in the 20s. Then the market, you can see right here, if you can see my cursor, it fell. I'll try to annotate it here. It fell from the high here down to about 50% down very quickly. Then it rebounded all the way back to 70 cents on the dollar, but then eventually couldn't hold it, and it went down, and it went down, and it went down some more, and eventually you were left with, if I can fix this here, a 90% drop in about 2 years. And it's why a whole generation of investors, or savers, I should say, swore off stock investing. That was too much for them, and it would probably be too much for anybody. So if that kind of thing happens, we want to raise cash, because holding your stock stubbornly, or I guess people would say patiently, is actually a mistake. So what we do is, if the market starts to fall through certain points, we don't just sit there and hold on. We will sell, not all, but we will sell many of our stocks. Anything that doesn't have a very clean balance sheet will go to cash, and we'll try to come back in lower. There's dangers of doing that. You might sell and then have to buy back more expensive later when everything is rosy. So you got to be very careful. But if you don't do it, there's no other way really to get yourself safe from a giant drop. Patience is one thing. I mean, if you were suffering through this 90% drop and you just waited a couple more years, you got most of your money back. But you really didn't get all of your money back for 25 years. Now, if you bought down here, you made a fortune in a few years. 4 times your money in 4 years, huge. And then this period here, going into the 1950s, was a huge run up. You made many times your money. The market was 100 here and 600 here. So a decade and a half, you made 6 times your money. So we just want to be careful. We don't want to just sit around if the market starts to crash. And let me see if I can find this chart here. This is kind of how we do it. We draw these lines in the sand, we call them. The first line is where we think people are going to get nervous. Investors are going to get nervous. And if it hits that line, we raise some cash. I think we raised maybe 15 to 20% cash there. And then we drew another line that we thought, if the market hits this next line, people are going to panic. So when it hit that line, we raised quite a bit of cash in the stock accounts. Now, you should already have cash on the side. You should have a bond account. You should have your gold. This was just in the stock accounts. We just raised cash. Also, we had probably 9% gold for the last year and a half inside the stock account, so that helped as well. But once these lines are crossed, you just get out. And it's not easy, because it feels like you're selling at the low. But if you don't do that, you can't protect yourself from these drops. On the other side, you have to be ready to come back in. So we drew a line here. Every day, basically, we look and say, where do we think people will start being greedy again? We didn't catch the low, we never will, but when it bounced, we started buying again. And we got some decent buys in the oil stocks and things like that. Right now, the market made a nice move up, started to roll over. We actually raised a little bit of cash that we had spent down here the other day, and that so far is not working, because the market is back up to the high here since the crash. So that's kind of what we're doing. No one really knows for sure. I don't know if I clocked in longer than I thought. I'm probably way over time, but it's a little deep of a subject matter. So that's what we're doing. Be careful what you buy. Watch the debt. Watch your own debt. Keep it low. Keep it zero. Buy stocks that don't have a lot of debt. make sure they're clean, make sure they're not too high a price. And then when all else fails, don't be afraid to sell. And you can always come back in. If you do it wrong, however, I've seen people sell down here too late. You got to be very careful about that. So let me take this off here. So that's kind of our take on it. It's never easy, and it's stressful. But the reason you're doing it is because over the long run, stocks have been a decent thing to invest in. It's one of the best things to invest in. We just need to be very careful. And in the next few years, I think with the debt loads of all the countries of the world, we're going to keep a gold position inside the stock accounts. We might trade it in and out, but we're going to keep it there. Other than that, we're going to just try to be flexible. There's going to be times to buy and there's going to be times to be cautious. And we're going to try to do both. So that's about it. Hope this was helpful, and hopefully I wasn't too long, but I usually am. Thanks.